Are we entering a crypto bear market? It's time to face the facts. In this video, I'm going to attempt to give you an unbiased opinion on both sides of the story of whether we're entering a bear market or if we'll continue on a bull cycle. And I really want to take a look at the facts. And in this video, we're going to spend some time talking about what's really happening in the world right now, because there's some geopolitical macro factors at play here that's causing things to happen not only in the crypto markets, but in the stock market as well. So first we'll cover that. Then we'll go ahead and take a look at the actual charts to see how they're performing. And then I want to cover 5 things that you could do to prepare for a potential bear market, and 5 things to do to essentially protect your downside risk, because I think it's really important at this phase in the market to be protecting your downside risk just as much as trying to maximize upside potential. And I'd say it's even more important to actually protect your downside risk at this phase of the market. So let's take a look at what's happening. Obviously, if you take a look at the charts, it's not really been pretty. We kind of hit this local top here at 68,000 or so. And especially just these past few days, if we look here, it's pretty much been nothing but red here. So not exciting. There's a lot of fear in the markets, and there's a few reasons why this is actually happening. And let's go ahead and take a look. The first thing is, there's this looming war between Ukraine and Russia that's happening, and there's pretty much developments on this happening every single day. It seems like we had the COVID thing going on forever, and it seems like that's kind of dwindling out of the media's attention, and now it's all focused on World War III between Ukraine and Russia. And I don't claim to be an expert on politics or on war, but I have done a little bit of research on it. And essentially what's happening here is that Russia wants to claim Ukraine back. I guess way back when the Soviet Union started, Ukraine was actually a vital part of the Soviet Union. And essentially what Putin wants to do is he wants to go in there and he wants to retake Ukraine. So I can totally see it from his perspective. He wants to take back what was once a key vital part to the Soviet Union. And basically, NATO, the rest of the Western world doesn't want this to happen, right? And so there's this looming fear around war that's happening. Supposedly Russian troops have been invading Ukraine border, and they're kind of just playing this cat and mouse game over there on the Ukrainian-Russian border. And so this is obviously, besides what I don't claim to know exactly what's happening, but this is obviously causing a lot of fear in the markets, right? Because war is something that is very scary and causes fear in the markets historically. And so this is just what's going on there. Now, that's not the only thing that's happening in the macro sense of what's causing or could be causing the markets to behave the way that they are. Another thing is interest rates. As you guys probably know, inflation in America has pretty much just hit all-time highs month after month after month. I think last month was about 7.5%. The US dollar is losing its value. As we know, I think over 35% of all dollars that were printed in history were printed in just the last couple of years, with the COVID pandemic trying to pull us out of that. And so essentially the central government has the ability to manipulate interest rates in attempt to stimulate the economy. And for a long while now, interest rates have been pretty much near zero. And so this is obviously causing inflation metrics to increase. This is also, I believe, what caused the stock market to recover so quickly when it dipped back when COVID just started coming around. And so there's a lot of fear around them raising interest rates. Now, what does this mean? This is a really key important thing to understand, is that interest rates basically determine how expensive or how cheap money is. And so when interest rates are really low, there's high incentive to go on and take on loans to get more money and then invest that money. So invest it into the real estate market or the stock market or whatever. And so generally when interest rates are low, it's really good for asset prices because money's cheap and they want to basically borrow it to buy assets. And that's what we've seen been going around here for quite some time here. But there's scares. I guess JP Morgan says that there could be 9 consecutive interest rate hikes over the next 9 months coming up. So obviously, if interest rates do go up, money becomes more expensive. And generally, this is bad for assets. Okay. And so I don't know if this for sure is going to happen. This is just speculation. This is just talk. The Fed, a lot of the times, will say one thing and do the other. But this is a possibility, which is definitely causing some spook in the markets. And then I'd say the last thing that's really going on here is the fact that the Biden administration is basically set supposedly this week to come out with some regulation for cryptocurrencies as a matter of national security or national defense. Essentially, they want control, and so I don't know. A lot of people are scared about how the US is going to regulate cryptocurrencies, but we don't know really what's going to happen at this point. It could be good news. It could be bad news. We don't know. But we do know that more regulation is needed in cryptocurrencies, especially if we want to see huge money coming into the cryptocurrency space. And as mass adoption comes, there needs to be rules around how do we interact and tax cryptocurrencies. So this is just something that is also like, there's a lot of fear in the market. So if we take a look at, what's actually happening here and we take a look at the Bitcoin chart, you can see here that, it's been ugly. And I don't think it's unrealistic for Bitcoin to come back down here and to test this $30,000 low here. It looks like there is a lot of support here down at $30,000. So I would personally be very surprised to see Bitcoin go below $30,000. But again, anything can happen in the market at any time. But we could just be in a situation where Bitcoin starts to range kind of between $30,000 and say, $40,000, $45,000. And we just kind of range out here for a while until we see what happens with the war and we see what happens with crypto regulation. So it could be unexciting price action. And I wouldn't say this is something that is, completely unnormal. If we take a look at other network adoption technologies, which is a company like Amazon, for example, and people say, Adam, well, you can't compare Bitcoin to Amazon. They're completely different things. And yes, that's true, but they're also network technologies and they grow in similar aspects. If you look at network technology-based companies or assets, they all kind of grow in a similar pattern and they're very volatile. But when you look at it on like a log chart, it doesn't look that volatile when you look at it, when you actually zoom out here. Hold on one sec. When you look out at on a log chart, it actually doesn't look like that volatile, right? It pretty much just like looks up and to the right only. Oops, sorry, that wasn't even on the log chart. So if you look on the log chart, it looks pretty much up and to the right only. But when you take a look at like in the early days, okay, of Amazon, for example, you can see it was very, very volatile, right? I guess this chart is showing since 97. So if you look like 10 years in, so if we go to like say 2007, for example, that's 04, 06, if you look at 07 here even, we see that it's quite volatile. We see that, the market went from here to here. That's like a 65% drawdown that we saw even after it was 10 years into its inception. And so these aren't crazy things to happen, which, if we look at Bitcoin, what's happening right now from peak to bottom here, we're looking at, we're at 45%. And I don't think this is something totally not normal. And, on the same time frame of, taking a look at what's actually happening with the war looming, the interest rates, all of this, it's not only affecting cryptocurrency markets, but it's also affecting like the S&P 500. If we just take a look here, we've seen quite a dip here in the S&P 500 as well. And I think everyone's just scared that, interest rates are going to hike. And that's why people are maybe selling out of some of their assets, especially since they're in quite a bit of profit. If we take a look at gold, for example, gold has kind of been a safe haven asset and it's performed better in these last, few weeks here than the stock market has, just because, the fear around what's happening with monetary policy. So that's essentially what's going on. So let's go ahead and let's talk about 5 things that we can prepare for. God forbid that the market does continue to crash on down and we lose 80% of the value of the market, which again, let's just take a look at this. We're in 46% drawdown. If we did go down to like 75% drawdown, which I don't see it happening. There's just too many use cases in cryptocurrencies. And this is the first time where it's really different, right? People, in 2017, they were just speculating on price. And, we got this huge parabolic move upwards, and we were definitely in a bubble in 2017. And, things came crashing down like 80-90% plus drawdowns. But this was before we really had anything. There was no NFTs. There was no DeFi. I see people this time around, they're going to stick and keep their money in the cryptocurrency system, especially when there's easy opportunities to earn 20% plus on their stable coins. Why in the world would people want to withdraw their money back into the US dollar, which we know is losing its value at a record-breaking pace? So I don't see this scenario happening. I mean, I couldn't imagine worst case scenario, $20,000. I think it's unlikely. I don't think we go really below 30,000. If we do test this, maybe it bumps out a few people out of their, stop losses that put their order here at $30,000, but I can't see it really moving down further past that. And again, this is just my, opinion. This is not financial advice. Again, I know that anything can happen in the market at any time. Now, with that being said, let's go ahead and let's talk about 5 things that we can do to prepare or to mitigate our downside risk. But before we do that, this video is sponsored by blueedgefinancial.com/crypto. Consider becoming a member if you'd like to get access to our academy, our portfolio, our algorithm, and our crypto playbook to follow along with all of our crypto moves and get insight from my partner Lee, who's basically been trading Bitcoin since it was 1 penny. He's absolutely brilliant. Come on over to blueedgefinancial.com/crypto to join our private Discord server and get access to all these bonuses. Now, let's talk about how to prepare for a potential bear market if the market does happen to go that way. First things first is I think it's important to talk about protecting your downside risk versus maximizing upside return. And I think that really it's important that we do look at this on a longer time horizon. I think that, if you are looking at the market from a day-to-day basis, or you're checking your portfolio multiple times per day, it can be really stressful, right? And a lot of times you can overthink things. But when we really take a look at what's happening, there's, crazy, insane good news that's coming out with Bitcoin and cryptocurrency pretty much every single day. The adoption is continuing like never before. And I think it's important for us to understand and to have a longer time frame horizon. If you think about it in the course of the next 5 or 10 years, what do you think? Do you think cryptocurrencies are going to become less prevalent or more prevalent in the next 5 to 10 years? When the metaverse comes around, do you think cryptocurrencies are going to become less relevant? Probably not, right? We're currently tracking like the internet. If you look at internet adoption, we're kind of like where the internet was in like the early 1990s. We're at like only 250 million crypto users. And with the way that things are being adopted, it's not unlikely that in the next 2 years, we could have like 1 billion users inside cryptocurrencies. And I personally think that the market cap is going to go from like $2 trillion all the way up to like $100 trillion by the end of the decade. So I think that, we could get scared, we could get shaken out, but if you look at a longer time frame, then I think it's easier to make these bets on a longer time frame horizon. I think we can all agree at this point that cryptocurrencies are not going anywhere, right? All of the banks are getting involved somehow. Governments are getting involved. The biggest companies are getting involved. All of this is happening. I don't see it going away, right? That's just unlikely to happen. Second thing that we can really do here in preparing for a potential bear market is to stack blue chip assets. Okay. I would say that, now is probably not a time to be going and buying low cap altcoins. I would say that you probably want to stick to like top 20 assets that you're really bullish on, even just top 10 assets. I think that is a really great thing to dollar cost average into Bitcoin, Ethereum, maybe Luna, maybe Avalanche. I think are good options as well. But I think that, because all these blue chips are quite discounted, I don't think it's time to go in and buy these lower cap, altcoin gems, so to speak, just because these could have 90 or 95% drawdown. And a lot of them could never even rebound ever, even if we do go in a bear market and in the next bull market, we could never see these things rebound. So I personally think that at this stage, it's important to protect your downside. And buying quality assets like Bitcoin and Ethereum, they're probably going to have significantly less drawdown than small cap altcoins, okay? Another thing that I think is interesting is to actually come in and consider getting into sectors that are maybe not correlated to the macroeconomic backdrop, right? For example, things like gambling, things like, play to earn video games, stuff like this. I think that's not going to be as correlated with the entire market, because even if the market's in a downtrend or we do go into a bear market, it's not like people are going to stop playing video games, right? It's not like people are going to completely stop gambling, maybe a little bit less, right? But I think that these are less correlated with what's happening in the macroeconomic backdrop than a lot of the other maybe coins. So if you were to venture out into smaller cap altcoins, I think that, trying to find categories or sectors that are not correlated, that people are going to continue to use regardless if, interest rates spike or we go to war, then I think these are better bets. The next thing that I think is important to prepare is to have a steady stable coin stack. I think that, having 20 to 40% of your stack in stable coins is a good thing, especially with places like Anchor Earn, right? You've probably heard me talk quite a bit about this, where you can go and deposit your stable coins and you can earn 20% roughly on your stable coins. I think it's a good thing. I think it's important to have some of your money in stable coins, especially because you limit your downside risk, you can earn yield on them, and at the same time, it allows you to buy at better prices, right? If we do get a really hard sell-off, then, you can buy at better prices, which is definitely beneficial, right? And then the last thing that I think is important, two last things is, one thing is that, if we do go into a bear market, pretty much everything in cryptocurrency is somewhat inflationary, right? New tokens are being issued into the market. Even with Bitcoin, there's new supply that's being issued into the market every year, even though it's just a small amount at this point. So I think it's important to actually go out and to earn passive income on your assets, okay? And I've talked about this previously, but you can come to a website like coindex.com and you can come to single stakes and you can see, let's just say, for example, AVAX, you own AVAX, you can see where are the best places that I could stake and earn on my AVAX, or where are the best places that I could add liquidity. See, if I could add liquidity to this AVAX USDC pool, then I could earn 40% on my AVAX, which is pretty good, because say AVAX dumps 40%, but you're earning 40% in the year, you can basically negate that downside risk. And at the same time, you have 40% more AVAX. So if price returns to previous levels, then now you have 40% more AVAX. So I think it's an absolute no-brainer. And if you're unfamiliar with staking or providing liquidity or yield farming, then that's totally okay. I actually did put together a DeFi mini course where I basically explain everything that you need to do to get started with DeFi, to start earning passive income on your assets, how to do some of these things that I'm talking about, providing liquidity and staking your assets and farming with your assets to protect your downside and also maximize your upside potential as well. I think it's the smartest thing that you could possibly do. So what I'll do is I'll include a link here somewhere, a card here, to our DeFi Masterclass. It's a mini series. You can watch it for free. It's 4 parts. I try to make it really, really easy. So by the end of this, in like an hour, you know everything that you need to do to start earning passive income and understanding how you can master decentralized finance. So go ahead, take a look at this, and hopefully this video is helpful.